So you're looking to do some margin trading, and you're looking for a platform to do it on. So I'm going to show you how to do it on ByBit, which is, it's not the greatest, it's not the worst, it's definitely one of the better ones for consumers like your average Joe. But there's a few things you need to be aware of, and I'll give you a few tips, a bit of an overview of how it works, and things to bear in mind when you're doing it. So first of all, if you've traded things on exchanges like Binance and a number of other exchanges where there's a lot less risk involved because you're not using leverage, you're just trading coins for coins. So if you make a bad trade, your coins will be worth less, but you'll just be stuck with bad coins. You know, you won't lose everything to a zero balance. When you're doing margin trading, it works completely differently. You are actually putting your money up to be lost altogether. You can make much bigger gains, but you can make severe losses to a zero balance if you're not careful. So like I say, it is something that can be very profitable to use, but it's not for the faint-hearted, and it's not for people to be doing. I wouldn't advise doing this if you've not had any practice in at least doing exchanges, or even just generally not knowing anything about technical analysis. You can follow as many people as you like on YouTube, including myself. Everybody at some point will conflict on their ideas. There's no right or wrong way to look at a chart in a sense. So you will always find someone who is bullish and always find someone that's bearish. Best thing for you to do is try and work out what it is that you think is going on based on certain fundamentals, technical analysis, chart readings, indicators, and all sorts of things. But that aside, let's get into ByBit and we'll work out what's going on here. So the way it works, very simply, you've got to buy and you've got to sell. Or if you think the price is going to go up, you press buy long. If you think it's going to go down, you press sell short. You can make money when the price of Bitcoin falls. And you don't have to trade Bitcoin. You can trade a number of assets: Bitcoin, Ethereum, EOS, and XRP. So the good thing about margin trading is that you can make money when the market is going down, which is something you can't do on exchanges. This is one of the reasons a lot of people would use margin trading for crypto, because a lot of the time crypto just goes down, and so you can actually make money on it going down. So I've got a tiny fraction, a little tiny morsel of Bitcoin here, about $50 worth or so, and if I thought that this was going to go up, I would press buy long. I could do a market order like you would see on exchanges, or I could do a limit order. Probably the better option I would say would be to do a limit order, because I like to have good risk-reward management, but I could also do a sell short. So looking at this chart now, it looks like it wants to go up, so let's just do a pretend. I'm not actually going to place this order because, like I say, I don't want to lose any money. First things you want to look at is, where am I going to want to buy it at? I'd like to buy it at this level here, where it's looking to make a bounce here. So I'd say I'd like to buy it at 9,980. So this here is your leverage. Now, if you don't know how leverage works, when you buy a coin on an exchange, you're essentially only going to make money on the value of the percentage going up. But if you do leverage, you could double that, you could triple that, 5 times, 10 times, 20 times, 50 times, or even 100 times. So if it goes up 1% and you've got it on 100x, it's the equivalent of it going up 100%, just in one little tick up. Okay, so extremely profitable. But the thing to bear in mind is, if it goes the opposite way, you will be losing money at 100 times the value of what it is that you've put down. So if I put down £50 worth of Bitcoin and it goes down by 1 tick or a few ticks, I would lose absolutely everything. So for an example, let's just show you this and how risky and how dangerous this actually is. I go to 100x, I put in my entire margin. So I've only got this amount of Bitcoin, by the way, £50 worth of Bitcoin, but now it's come up as this amount of Bitcoin was the equivalent of 3,841 Bitcoin. So if it goes up, it's the equivalent of me trading on an exchange with that amount of Bitcoin. But clearly, if it goes down by any amount, I will be losing it as if I had that amount of Bitcoin. So you'll see my liquidation point would be, if I bought it here, where it is at this tick now, and it goes down to probably about this level, I will lose my entire amount of Bitcoin. It'll be just gone into somebody else's pocket, and I'll be left with zero. So it's very risky. If you're doing margin trading for the very first time, I would suggest you need a lot of practice on it. I wouldn't do any more than a 1 or 2x, and I would strongly advise generally not doing more than a 5x on this. Even myself, I wouldn't generally trade much more than a 5x or anything like that. So let's have a look at how this works. So if I have my order price in at this level here, which is where I'd like to buy it at, I need to work out where it is I want to sell it at. I press buy long. Brings up this form here, so I get to say where I want to take my profit. So let's have a look at where the profit is likely to be going up to the top of this Bollinger Band. So not very much. I would say I'd like to sell it here, make a quick entry and a quick sell. I would put it in here. I'd put my take profit at 10,014, and I will make a tiny little profit here at a 1x. I mean, it's a very, very small profit, but it's a profit all the same. That's where I'd be looking to make that profit. Stop loss, this would suggest where it is that I would be willing to call it quits and suffer some losses, but I don't want to lose any more than I'm prepared to lose. So I would say I'm probably looking to have a stop loss at around about I'd say 9,000, and we'll say 9,065. So I'd make a loss there, an estimated loss there. And then you press confirm and you wait for your order to be filled, and if it gets filled and goes up here, it will be sold, you make a profit. If it goes down here to this level here, this is where I'd say that it will be sold out. So what I've shown you there is just a brief overview of how it works. It works in the opposite way. If you want to make a sell, so I want to sell this order here, I think it's going to go down from here. I'd do exactly the opposite. I would say, where do I want to get this purchase in? So let's just say it went up to this level here again at the top of the Bollinger Band. I'd do a sell short at this level. Something's going a bit weird there for me. Oh yeah, it's all gone a bit strange. Never mind. Right, so yeah, sell short here. So I would do exactly the opposite. I'd take profit where I'd like to take profit. I'd say I'd like to take profit at 9,065, and my stop loss, I'll probably say I'd have a stop loss at 10,000, and we'll say 10,025, and I'd make an estimated loss of that figure there. Confirm. Now, when you're looking at these charts, obviously I've got some indicators here that I like to use my moving averages, but this purple line here is where the order book's being placed at here. So if I wanted to do a market order, which is buy exactly where it is right now, if I was to make a buy here, it wouldn't be buying it at this level here at 10,009. It would be making the buy order here at 10,013. So I'd actually be buying it at a loss already. So you've got to bear in mind that when you make when you buy something on ByBit, first of all you've got a premium you have to pay for, which is a fraction of the amount. So it's usually less than 1% of what it is that you've put down. So you're already at an automatic loss anyway. But then you'll be buying it where the order book says, which is this line here, this purple line going up and down. You can see that the line there, it's represented by this figure here. That's the price that you'll be buying it at. So you're automatically buying it at a loss if you were to buy it here. Now this ticket can go up and down, depending on where it is in the order book. But right now it's here. So I wouldn't really be interested in doing it right there, because, like I say, it's going down anyway. By the looks of things, it wants to come down anyway. But that's something else you need to bear in mind. You're always going to be buying at an automatic loss. So when you're buying at a loss, you need to be pretty sure of where it is that you want to get in. It's not something you want to go in willy-nilly. You don't want to be just making purchases and shorts and longs because you have a rough idea of where it's going to go. I have a few rules that I use, and I would suggest that you employ these rules as well if you're looking to do this. And again, if you're looking to do margin trading for the first time, just do a 1x and practice and practice and practice. Don't go thinking that you've mastered it now, let's go 100x. You need to just keep practicing on this one and employ these rules that I'm going to say now. So the first rule is, when you're making a buy or a sell, you need to be able to justify exactly to yourself why it is you're looking to make that buy there or that sell there. If you can't justify it and say that it's going to go down immediately or go up immediately, then just don't do it, because you're going to lose money. This isn't something that you just want to be placing, just for the heck of it. Okay, I appreciate people don't have much time to do these sort of things, and if that's you, then I probably wouldn't do this yourself anyway. This is something that you want to do carefully. So let's just say I mean now is not a good time for me to show you this, because it's not, it's looking relatively volatile. But if I was to be saying, can I justify that this area is going to go down. I need to justify it to myself. I need to justify it with the indicators. I need to justify it with the overall trend. And if I can't justify it to a pretty certain degree, I just won't do it. You have to be disciplined in that respect, and just leave off, because it's better to miss out on an opportunity than to actually lose money. And so always be able to justify why you're making that position, why you're getting in at that position. Secondly, you want to have very, very strong risk management. So it was when I was showing you the stop losses before. If I am able to justify to myself why I'm getting in at a certain level, so if I want to do a short, if I was back in time on this ticker here, if I could say I think it's going to go down from here, I'm almost certain it's going to go down from here. I would place my short sell in the hope that it's going to go down. But if I was wrong, I don't want to be losing any more than I need to. So I would have a very tight stop loss at probably around this level here, just above the Bollinger Band, because like I said, I've justified it to myself that it's going to go down. So if I can justify it to myself, if I'm pretty sure it's going to go down, there's no reason why it should go back up. But if it does go back up and I was wrong, I've only lost a tiny bit. I haven't lost any more than I needed to. So have good risk-reward management, and have a very tight stop loss, because so long as you followed the first rule, this shouldn't happen. The second rule is just insurance to back up your very first rule. The third rule is have a sell order, and I know this sort of sounds a bit silly to some people, but when you're doing this, and you'll probably find that when you're doing this yourself, if you've never done it before, that you might start to feel greedy. If things are going your way, you're thinking, I can just hang on a little bit more, I can just hang on a little bit more, a bit more profit. No, try not to think about it like that. Right? If you have got a position entry, you need to think about a position exit. So we're in a trading range here which is zigzaggy all over the place, very volatile, generally to the down, but at the moment this isn't a nice trading range to trade in. You don't want to get in a position anywhere like this, because it's going all over the place. So if I wanted to make a quick buy and sell, let's just say I was selling here where we said we were going to sell before, I'd make my order placed here, I'd have my stop loss here, and I think it'd be realistic to assume that perhaps it's probably going to go down towards the bottom of the Bollinger Band before it goes back up again, so I'd probably put my sell order in here, 9,955. So let's just show you how that would work on here. That's your stop loss, where you do your risk management, and you take profit, where I'd say that's where I want it to be sold at. That way you can lock in profits, because sometimes you get wicks like this, which would be great, if you wanted to hold on to it and just let the whole thing ride. But look, it's just a wick. It went straight back up again. I know it went down, but it's just a wick. And sometimes you get wicks like this that create bounces. And the worst thing you want to do is see that you could have had profit and then it go back up again and actually trigger your stop loss. And the fourth rule I would say to stick with is just be disciplined. Alright, be disciplined about what it is that you're looking to do. Employ all those rules that I've said. Don't deviate from them. If you want to have more rules, fine, but those 3 rules that I've set for you, for myself, even me, who I've been trading for over 5 years, and I have about 70% of the time it works out for me, and that's all you need. You just need the majority of the time for it to work out for you. So long as you have those rules set for yourself with good risk and reward management, tight stop losses, realistic sell targets, and being able to justify why you're making that position entry in the first place, and just be disciplined about the whole thing, you should still end up making money. But you have to be disciplined. So that fourth rule is discipline, and you've got to stick to all of those rules. If you deviate from them just one time, you could wipe out all your money altogether, completely all gone, and you'll wish you could just go back in time and just tell yourself to stick to the rules. So just stick to those rules, okay, and you should be okay. Anyway, I hope that's been useful for you. I'll leave a link at the bottom to set yourself up a ByBit account if you're interested. You don't have to use my link, obviously, but if you do, I think there's perks for both of us. There's certainly a little perk for me, anyway, and I think there might be something in it for you. I'm not entirely sure, but obviously just use that link if you're interested. And like I say, if you decide to use ByBit or any margin trading platform and you've never used it before, just practice with a 1x. until you've got the hang of everything, don't be greedy. Money will come to you if you have the patience and the practice and those rules. You will be able to make money, but you have to be disciplined, you have to stick to those rules, and you have to have practice. I wouldn't suggest using anything more than a 2x, generally across the board anyway, for most people. I, for one, would only use a 5x most of the time, at best. And just be realistic about what it is that you're looking to achieve. No one's going to become a millionaire with a small amount of money straight away. If someone did, then they would. All you could say is that they were very, very lucky. And we don't rely on luck when we're doing these sort of things. We rely on technical analysis and strict risk-reward management, and generally, just playing it safe. Okay, we're not gambling here. This isn't gambling. This is a tool for you to make money, as long as you use the tools correctly. Anyway, thanks for watching. I hope you have a nice day, and take it easy. See you later.